Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Care Ratings, which is a portfolio stock, and I believe that it could be a long-term hold, but what prices to buy it and will this slide arrest? So we'll understand about it and the business. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position to any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Care Ratings, a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel. If you also ask me questions in greater detail, once you get the $10 membership, you'll have access to my portfolio, my watch list, and a number of podcasts that I put up from time to time. And also, if you can pay $100 upfront, then you get 1 year access by paying for 10 months. So that's a 20% discount. For detailed market or company talk or one-on-one discussion you want to have with me, you can directly email me and we can work things out with a fee. Now about the company. Formally established in 1993, Care Rating is focused on providing credit rating services across the board. One of the leading rating agencies spread across the country, helps companies in raising capital and investors to make informed decisions on particular stocks. The market cap of the company is around 2000 crores, so it is one of the smaller companies in this in the market and is in the small cap index. If you look at the financial, and these are March quarter numbers versus FY20 numbers. So sales were up by around 22%. Profit jumped by around 60% to 26 crores, which is pretty good. It is a zero debt company with a high operating profit margin of 38%. So very high, you can say, margins, etc. is with Care. If you look at the performance, stock has been a strong underperformer over the years and has fallen over 60% from the 2017 highs. In 2021, it has given a 70% return. So what happened is from 2017 till 2020 February, it fell nearly 60-65%, and from there on in, we have seen, you can say, jitterness in the stock, and the company or the performance of the company on the bourses has not been that great. But over the last 8-10 months or 7-8 months, it has given a return of around 70%, which is quite decent. The return ratios is pretty good, and the kind of business that it is into, not many companies can get into, so there is high barrier to entry, and that is why I believe this is a good long term pick. Yes, on the short term, maybe because of lower liquidity and many other factors, maybe the stock may not move that much, but over a longer term basis, we will see that the company should end up doing pretty well. Top management with backing of high grade institutions, and that is a huge positive when you consider about something about Care Ratings. The sales and profits are declining gradually, but over the last 2 quarters, numbers have been better. So over years, sales have dropped, but now I think we can say, and it might be possible that the company has made a bottom with respect to quarterly numbers being bad. And I suppose that going forward, the numbers are going to be even better. Attractively priced at 18 times earnings, this is pretty good, 16 to 18 times earnings, and that's why it is a very good company to probably buy and hold on to. If you look at the technicals, then there is strong support around the 600 levels. It's around 670, 673. What you can do is buy at current levels. On declines to 620, 630, you can buy more. It has run up recently, and over the last 7-8 months has done appreciably well. So you need to take that into cognizant and probably buy on declines at current levels and declines. It is headed to 980 over a period of time, maybe a year and a half. You'll see the stock at 980, but over a 5-6 year period, it is a very good stock to hold on to. It may consolidate at the moment, so that's why I told you to probably buy a few shares here, and then on declines you can buy more. So what needs to be done? Can be bought on declines and at current levels, may do well over the next 5-6 years. So it is not that it will do very well immediately, but you can accumulate and have a 5-6-8 years time frame, and better to buy into other reasonably valued consumption companies. I think more consumption companies may end up doing well. I have a little bit of favor towards that, but if you really want to buy into a rating agency, Care is pretty good, and the way it is performing, so it is a top long term buy. So this was my video on Care ratings. Please like and subscribe my channel, hit the bell icon so you can get my videos straight away when I post it. Thanks a lot for watching.